All right, everybody, welcome back. Welcome back. We are about to jump into our next session. Mr. Michael Baughman, here he is. So, Michael is an extremely talented presenter. He is our customer success manager here at Holistiplan, and he also is a financial advisor of 22 years, specializing in tax planning, estate planning, risk management, all the things. So, Michael, this is one of the most in-demand products that we offer. Last time we had this session, we like the demand for the tool just skyrocketed. So I am super pumped about this session. And we have a great audience as evidenced by like the pop-in Q&A, super supportive, really engaging. So you ready? I'll hand it off to
I'm
you.
ready. Yeah,
All right, let's go,
excited.
Michael.
All right, I'm going to may need to allow me to share my screen. Perfect.
While Michael is getting set up, I'll give you a little bit of background on the multi-year Roth projection tool. So this was something that we actually rolled out earlier this year. It's something the clients had been asking for consistently. It's an extension of our scenario analysis tool where we had a module that focused on single year Roth projections. But as many of you know, the beauty of having a multi-year Roth tool is being able to forecast over multiple years. And so the multi-year Roth projection tool was built. And that's what Michael's going to talk you through today.
All right, Laura, give me a quick thumbs up. You can see my screen here.
Yep, looks great.
Awesome. Thank you, everybody. And yeah, so you have made it to the final session here, and so congratulations, and certainly excited to be with you. Just as Laura said, so this is really going to be a workshop today, so we can. You've hung in there. You've gotten 3 hours of continuing ed for CFP, which is a big deal. And I certainly want to give a quick kudos out to all our previous presenters for all the work and effort that went into today. And a big kudos to you, because we've had some incredible content. You've hung in there and you're still here. And just as a heads up, this is not CFP CE. We're going to be looking at a kind of a high level overview of how to get going for many of our future users that are here. And then we are going to spend most of the time today really drilling into the Roth projection tool because we know there's a lot of demand, a lot of questions, a lot of great use cases for that. And so, yeah, just again, a great kudos to all the folks that have gone before us. So, for those of you who are existing users, want to encourage you to make sure you have signed in to Holistiplan if you're not already. And you go ahead, if you haven't, upgrade to premium if you need to have access to the multi-year Roth projection tool. And then you would actually find that in settings and subscription. If you're a new user with us or a future user, I really want to encourage you today to roll up your sleeves, and you can join a 7-day free trial. Roll up your sleeves and start to test it out. And we know plenty of evidence out there that proves that we learn by doing, right, versus listening or watching. And so it's rolling up your sleeves. It's playing in the sandbox. And so hopefully we can all do that together. So that's our plan today. Most of it's going to be the Roth projection tool, high level, quick demo in terms of getting going with the software. For those of you that are new users, just want to make sure you're clear on how to do that. And I'll give you just a quick backstory on kind of how I got here. I was such a believer in the tool and in the tools that Holistiplan has that I joined the team almost a year ago now. So was an advisor for a couple of decades, heavy user of Holistiplan, and really just saw the impact that tool had on me, my ability to help clients, my ability to get the conversation away from portfolio, away from investments, away from economy, stock market, politics, and get into something else that I can deliver a lot of value without having to be an expert. You know, this tool does so much for us. It has so many great client-friendly tools that allow us to show things to clients, to educate clients, to work with clients, that it really, I would say at this point in time, there's never been a better time to be a financial advisor. And, I'll just click to this next slide here because, and I don't know if any of you have ever felt this way, but I certainly felt this way a lot over the last couple of decades. I just felt like it was hard to do it all, hard to be in command of everything, right? State laws are changing, tax laws are changing, politics are dynamic, the economy is dynamic, right? Just all the things we've navigated over the last couple of decades there. Throw in a throw in a throw in COVID and a few other things like that. And it's been a challenging time for all of us in this profession. And so your job is incredibly important and it is incredibly challenging. So I just first want to acknowledge that. And you really want to make sure that your clients are getting an efficient, an effective, and consistent experience. And so, in order to do that, to juggle all the things, there has never been a better time, in my opinion, to do all the things, to deliver customized, comprehensive tax planning at scale for your clients. And so, Holistiplan really allows us to do that. And so, in under an hour, we're going to walk through creating an account for those of you that are future users. We're going to upload a return. We're going to do some quick scenario analysis just so you have a sense to take a look at that. And then I promise for those of you who are here for the Roth projection tool, that's where we're going to spend the majority of our time. All right. So this is not a sales pitch. This is a working session, and you're going to use Holistiplan with me. So we're excited about that. So we've hit this. We're going to really jump into the scenarios here, look at getting started, uploading a return, a tax report, and then looking at a scenario. We'll do the Roth demo, and then we'll have some Q&A. So I'm hopeful you're going to walk away with a number of things, but maybe 3 key insights, just some better ways to save time, some planning insights, and some ways to arm you with better conversations with clients with less prep. So this is a quick look at the tax report, and we'll show it to you here in a little bit more detail here in just a minute. But I think sometimes we gloss over what happens to create the tax report. It is not just lifting data from the tax return. Deborah Taylor and I were reminiscing about what it was like to review a tax return prior to having software like Holistiplan. Painful, excruciating, not efficient, not scalable, and opportunities for errors all over the place. And so I have lots of scars from having to go through dozens and dozens and dozens of pages on a tax return. So I have an appreciation for how incredible this tool is. And what it's doing is it's actually running its own tax calculation. So it's not just lifting the data and regurgitating it back into our tax report. We are running a separate side-by-side tax calculation. Just to make sure what's on the tax return is correct. Our users find examples of where that's not the case. And so if you do nothing else, it is a second level review of a tax return that allows us to just make sure what's on there is accurate, because CPAs are humans, tax preparers are humans. They have a lot on them, especially during tax season, and errors happen. And so we find it, our users find it regularly. And man, what a great value add to go back to your client and say, listen, we found an error when we did a review of your tax return. It's going to save you a few $100 or maybe thousands of dollars. But just the fact that you did it, I think shows an incredible amount of value. So that OCR process is doing a whole lot behind the scenes. It's taking it, bringing it in, and then we are running our own kind of baseline tax calculation that gets put over into the other tools that we use. It allows us to plan for any scenario. So what you're seeing here is just an example out of Holistiplan and really looking at what scenario analysis looks like. But we go from data to decisions very quickly. We take the tax return, we upload it, we've got our baseline tax report, and then we can jump right over into scenario analysis to start making decisions or helping our clients make decisions and to start playing in the sandbox to show the impact of different things that we want to show them. So this what if scenario modeling really is, I would say, the power of our tool. Really brings these potential planning opportunities to life. And so with that, we're really going to just dig right in and do just a quick high level demo here. I'm going to do a quick change over to stop sharing my screen, so stand by. All right, so here we are. We are now in Holistiplan. This should look familiar to most of you if you're current users. Again, for those of you who are new users, hopefully you've had a chance to get that free trial, and you're in the system, and hopefully this is starting to look familiar to most of you. But really, the first thing we do as a new user is we want to create that household. Step one, right? So from here, we'll basically just click on households. You're guided through that as a new user the first time. And when we create that household, we'll do it right here. And you really just want to put in that first name, that last name here, if it's a married filing joint couple, right? So very straightforward. We're going to enter their state of residence, their date of birth. That's all we need. First name, last name, date of birth, state of residence. Not a lot of data entry. And we are not pulling personal identifying information from the tax return. So we're not going to know names, dates of birth, or anything like that. So we need you to tell us, get the household created. Once you've done that, make sure that state of residence is accurate, because that allows the tool to pull in some state tax hints that I'll show you here in just a moment. So that process is very easy. First name, last name, date of birth, state of residence, and then you've got your household. Okay, so today we're going to be looking at the John and Sally Smith household. But from here, what I want to show you is I'm going to assume you've created your household now. All right, and so this is what it will look like. The first time you create a household and you upload a return, some of these things aren't going to be here. But look, we've got things already showing up, right? John and Sally, just based on date of birth, based on what we input when we put the state of residence in and their date of birth. And now we've got some things like age milestones starting to show up. Powerful part of the tool. We don't even have to have a tax return just to start getting some benefits from the tool. So I'm going to show you how to upload a return. You can see I've already got one in here for the Smiths, but this is a demo client for me. But I'm going to basically walk you through. You just click on upload, you tell it the tax year, you click here. Hopefully you've got that tax return stored, saved somewhere. If you don't, I'll show you where to get it for a new client. Or even just a sample clients under tools and resources. You've got the ability to pull down a sample upload. And so John and Sally Smith, I've already pulled this one down, but this is where you can go to get it if you need some help getting a sample tax return. Your own tax return is another way to get started. Your family, folks that you might be doing work for, great way to get going. But start on yourself. If you don't want to, I would say start on one of these sample households. So we're going to go back now into assuming you've got that tax return, either a sample or someone else you can work with. So uploading the return is very straightforward. Clicking here, we're telling it where we've saved that return, obviously. And then for me, I've already got it in, so I'm not going to upload it, but that's the process. You click on it. Actually, we'll just go ahead and do that so you can see what's happening behind the scenes. So now is that second level review, that optical character recognition process, reviewing the return, pulling over data, but also running our own baseline calculation to make sure everything looks good. So assuming everything looks good, you'll end up with a green check down here. Tends to take 30 to 45 seconds. You can see we've got our green check right on cue. So that worked really well. That happens 70% of the time. If for some reason it wasn't a full return, or there's some reason it needs to get kicked over to our second level review, which happens about 30% of the time, you'll hear directly from our support team about what's missing or what steps need to happen to do that. For users or new users, quick opportunity to show you our knowledge base. I just found that under help knowledge base, because you can search here in terms of what forms do we upload. If you have any questions on that, we've got a great knowledge base article on that, basically saying, hey, we want you to upload the entire return. Don't make it more complicated than it needs to be. We don't need to just request certain schedules. The more of the return that's in there, the better. If it is missing a schedule, that would flag it for a second level review, and then it would just take more time and more interaction from our support team. But so that's the process for uploading the return. That's the process for getting to our knowledge base, which is an incredible resource. Anything that we've got in our tool, you can find here. Roth conversion, Roth projection tool, which is certainly our most popular use case. Lots of great resources here, walking you through how to do it. We're going to do this together today, but it's all there. It's in there. Trust us on that. So can't over recommend our knowledge base and our support team. Speaking of our support team, where do you go to get help? Anytime you're inside the software, hit the contact support. That's going to bring you straight to our support team. They're going to know from where you're coming from, and it allows them to get back to you in minutes usually. So they are an incredible, probably the best part of Holistiplan in my opinion, and I'm not alone there. So reach out to them. and anything technical related to the software, they can help. Search the knowledge base, contact support. Okay, so we've done our quick upload and we've got our client here. Just a high level review quickly of the tax report. Again, I know some of you are future users here. And so now what you're seeing is this powerful client deliverable that allows me to go from data to decisions quickly, right? I now have insights. I haven't even looked at the return yet, and I've got key figures coming off of the return. I've got marginal and average rate or effective rate. Those things you'll never find on the tax return. That's a separate calculation that's being done. So safe harbor, what do we need to pay in this year to avoid estimated tax payment penalties, right? Something helpful to know. Not going to find that on the tax return. Right-hand side, just a breakdown of the portfolio income. As the return gets more interesting from a tax and an income standpoint, this chart gets more colorful. So it's going to show you all the different types of taxes that are being created on the different types of income that this client may have. This is a pretty straightforward client, retired, not a lot of things happening. We get into the marginal brackets. We start to show you the progressive nature of taxes, right? And it's a great way just to inform and educate a client. I've said this before, and I can't say it enough. There's nothing bad in my mind or opinion that comes from just walking a client through the report. You don't have to have some great idea or some great recommendation. Just spending time with them. We're not talking politics, portfolio, or investments or economy. We're talking taxes, which for a lot of folks is pretty dry and pretty not exciting. This brings it a little more to life. Now we're starting to help you with some insights as well. Amount of ordinary income left in the current bracket. That's helpful, right? That's potentially something I want to think about from a modeling standpoint. So we're helping you understand how much room do we have left in the bracket. We've solved that for you. Then we walk through the different types of income, qualified and ordinary, and how those are taxed differently. Many clients are not aware of that. We help you educate and inform your clients on that because look, this client had portfolio income and they paid no tax on it. And we still had a little bit of room here in this bracket, right? Before we started making qualified income taxable. So that's a little bit of about how the report is structured. As we get on further down, basically we're walking through all the different types of income. The Schedule B is a treasure trove of information about where assets are that are generating income. Bank accounts, other investment accounts that we may not know about shows up on the Schedule B. We want to make sure we know what those are, and hopefully we're managing those or we're aware of those accounts. We'll skip through some of the portfolio income and we'll jump all the way down for time purposes, just in the observations, because I will tell you this is really where we go from the data to some recommendations specific to this client's tax return, looking at the observations here, and those are specific to this client. So I tended to like to hide a few of those if I didn't think they were relevant, or I was trying to boil this down to 3 or 5 key observations and not throwing the kitchen sink at them, right? Because that can get overwhelming. The more data we throw at a client, the quicker we are going to lose them, more often than not. So there's a lot of good stuff here. I may not want to show all that, but that's one of the tips I would use as an advisor, was just trying to boil that down to what's the highest and most important priorities that we want to talk about. And then we've got the state tax cents at the bottom again. That's just pulling it straight over from that state of residence, not pulling it over from the return. That's the tax report in a nutshell. We've got a lot of information and resources back on our under our webinars. If you want to go through and get a deeper dive into the tax report, into our just how to use the software and get going, I would encourage you hit 101, hit the 201. You can watch those on demand, or you can register for what's coming up. So can't overstate that. So now we're going to do a quick look at scenario analysis, and then we'll jump into that Roth projection tool. And we'll stick with the same client because we've already got an idea, right, that came off the tax report. So I'm back in their household. And so from here, I want to jump over into scenario analysis. Got my 2024 return. Going to go ahead and jump on in here. And I've already created some scenarios here for purposes of our time, just knowing we didn't have a ton of time. What you're seeing me do is move a few things over to the bank, which is over here. Great place to go ahead and pre-build some scenarios and then hide them so you can bring them back later. But in this case, what I've done is I've created our new baseline. I will always encourage you to always create a baseline scenario. And then from there, if you add a new idea, any kind of changes or ideas, anything you want to test, let that be a new scenario. So let's get a very clean baseline scenario, which is what I've done here. Um, and really the only changes I made was I bumped up their IRA distributions for the fact that there was a cost of basically inflation and the portfolio was a little higher and their RMD divisors getting a little bit larger, and then Social Security cost of living adjustment. Those were the main changes that we made from last year to this year. And then, oh, by the way, there's now a new tax law that is embedded in as current law. So I've got my baseline. I am now using this as a way to help me solve for that Roth conversion amount. Two ways to do it. That solve for min-max button is going to just allow us to quickly come up with the number that's going to tell me what would make sense before we make a change to their effective tax rate. And then range calc is going to let me do it visually. So if it's the first time you're seeing range calc, I'll tell you there's a lot here. It takes a couple of reps before this starts to truly make sense. It certainly did for me, but we have anticipated that, and we've got a lot of great resources in the app here. So if it's the first time you see it, or it's the 10th time you've seen it, and you have a question, now that we have this new enhanced senior deduction, we've got a new color that's green. You can pop over here and you can start to see, hey, what's showing up? I've got something that's green. I've got something that's red. Help me understand what's happening. And then we actually will explain that for you. But we have a lot of resources on range calc, so I'm not going to spend a lot of time here. But basically what this is telling me is that as I add additional income on top of their baseline, what's happening? We're rerunning that tax calculation every time. And so what this is basically affirming to me is that I have about 17, 18,000 before I start making their qualified income taxable. That's what's happening with that red that's popping up. You can see. So if I get into the $21,000, $22,000 range in terms of a Roth conversion, I'm now going to make qualified income taxable, and that's really going to make their federal tax rate closer to 27% versus 12%, which is really what I'm solving for. So that's range calc. Same chart for qualified income as well down here. But from here, I'm going to jump back into scenario analysis quickly, and then just show you if I add in if I add in this Roth conversion, which I'm going to bring on over here from my bank. The only thing I've changed here is I've basically gone in and I've added a Roth conversion right here. Okay, and it's going to show me that impact, the effective rate of those new dollars and the actual incremental cost. And so now I've got a recommendation of $15,000 Roth conversion. Let me go back here, and I want to actually see the tax report now, just to confirm. We're in the sandbox, right? We're playing. We're wanting to make sure that we're not missing something. So we're solving for the 12% bracket. We knew we had a little more room there. And so here we are. We're basically saying, hey, your total income is 87. We're still under this ordinary income threshold of 96 before. So, hey, we left some room in there. That's right, we did. Why did we do that? Well, we were more worried about this bracket. We were more worried about that bump up for qualified income. And you can see we've kept them, that's their taxable income. The next bump here is 96. So success. We were able to generate a Roth conversion without making qualified income taxable. So that's the headline and a little bit of the detail for you newer users around tax report, scenario analysis, how to go from I just got going to now I've got a return to we have looked at the tax report, we've gone from data to decisions, we have run the scenario analysis, and we've come up with an idea that says $15,000 Roth, and now we've confirmed that that was a good idea in terms of being able to go back and check to see, hey, did anything else happen? Did we push them into that next Medicare bracket? We did not. Right, we're still in this threshold here, which is good. That's always something you want to be aware of, and you want to remind your clients of if you are pushing them into those new brackets. So that's it on scenario analysis, on tax report. Can't say enough about going to our help, going to our knowledge base to get more information and resources on that for you new users. Now we're going to pivot and we're going to jump over into our Roth conversion. So just stand by for one moment. All right. I'm going to re-share my screen now, and we will walk through this exciting Roth conversion that we got prepared for you. So hopefully you guys are still hanging in there with me. The rest of this is all about Roth projection. So excited to jump in here with you. Okay, we are back at a familiar screen, and I'm just going to treat everybody on the call still this is a newer tool for you, right? So we're going to walk through how we get going from the beginning all the way through the process. All right. So I've got a kind of a test client that I want to show you. So we enter the Roth conversion tool from our households. Okay. So you don't need a tax return to actually create a Roth projection scenario. So I have got my Tony Hawk and Cameron Diaz household here that we're gonna spend some time with today. So I've already entered them in, so I have them as a household, and I don't have a tax return. So you can see here, all I've got is their date of birth, and I have their state of residence, and that's it. So if we scroll on down, you can see no, we don't have a return. I do have a couple of existing Roth projections in here, but we're going to create a new one from scratch together, and we'll walk through that. So the first thing it asks you is basically it's going to ask you to just create the name, and we're going to create the household here. So hopefully you're tracking with me. Uh, we're going to make taxpayer 1 Tony Hawk. We're going to do it for 2025. We're going to make taxpayer 2 Cameron. If for some reason we knew this client was blind, this is where we would click to add that additional deduction for them. But in this case, no new information on that. So now I have my Roth projection here. I'm going to click into that, and you're going to see this wizard populate. And so we'll go ahead and start the process. We're not pulling the data over right from the tax return or from any sort of scenario. You really have to go through this wizard. And I'm someone who despises data entry or inefficiency. And so I can tell you to get the data entered might take us 5 minutes at the most. And so I'm going to be talking while we do it. So I'll also give a credit back to Emily, who's done a number of these workshops for us on Roth. And so the way she likes to explain it is she likes to think about, hey, that we're cooking together. So the first thing we want to do is we don't want to start with a Roth conversion. You know, we want to start by making sure we have our assets entered, and let's start to let the tool help us make some decisions. She also talks about using this tool as like if we're driving from, I'm in North Carolina and we're driving over to Los Angeles, who would do that? But let's just say we're making that cross country trip. You know, we don't necessarily need to be real precise. Let's just put in Los Angeles to the Google Maps, and it'll get us most of the way there. And then we'll get more precise as we get closer. So that's how I want you to think about this tool. We don't have to get too precise right now. This is allowing us to not have to go over into another planning software to model this out, but to come here and to really let this tool help us, because we've got the tax calculation down on our side. We're very, very, very good at that. And so let this tool start to help us on that. So for Tony, client 1, we're going to go ahead and put in terms of taxable assets for the 2 of them, we're going to put in $150,000. And we'll say cost basis is 75 in this case. So Tony has a larger IRA, so it's 1.2. And Cameron stayed home, raised kids for a few years, so was penalized financially a little bit for that, but worked her tail off. But her savings in a retirement account are less, so we're going to give her about 400. And then combined Roth, we're going to give them just a little bit of a starter. You don't have to enter anything there. You can put 0, but we're going to just go ahead and say they do have a little bit of a Roth account already. Rate of return. We don't have an opinion on this, but basically whatever number goes in there is going to be what projects forward on all of the assets growing. So we're not growing Roth accounts more aggressively or less. We don't currently have the ability to change that in terms of, hey, I want Roth to be this and I want tax deferred to be this. I know in practice that that's done a lot, but in this case, we'll just leave it at 8%. You know, pretty aggressive. We'll bring it down to 7. How about that? These folks are getting closer to retirement here, so we'll bring it down to 7%. Portion of returns that are capital gains. So, you know, the way I think about this, and we've explained it here as well, is that most of the growth of the portfolio, right, is growth, right? It's not income. And so when we think about the majority of the growth from a portfolio being return or appreciation and not income, that tends to tilt me closer to say 75% here. Have your own assumptions here and think that through, but that's certainly how I was going about doing this was, 75% of the growth was of the returns were growth. Okay. Life expectancy, 100's a little high, I think. I was in practice for a long time, had one client make it into age 100, and she was still driving at that time. Couldn't see very well, but so it was fascinating. And it wasn't until I moved to this little place I live now where that even happened. So Social Security start year, we're going to make it age 70 for Tony. And for him, we're basically going to say it's 42,000 because hopefully they're taking our advice on this and allowing us to help them delay Social Security as long as they can to potentially allow more time for some Roth conversions at lower brackets. So for Tony, we're recommending that he wait till age 70. Yep, you can see some things happening here. I put age in there, and but I didn't have the age icon selected, so it'll tell you. If you make a mistake, something red will populate here. For Cameron, we know ladies tend to live a little bit longer, but I'm going to make her 95 as well. And Social Security start age for her, we're just going to assume she starts at full retirement age. And then for her, we're basically giving her a slightly lower Social Security amount. How exciting is this? We're doing some data entry together. So spending, right? And we don't have to be perfectly precise. We know there are other tools that allow you to get more precise on cash flow and that sort of thing, though we do have some of that as well. We really just want a general idea from a spending standpoint, because the tool is going to calculate a cash flow projection. And so if you tell it, whatever we tell it from a spending standpoint, it knows that those dollars have to come from somewhere. Some of it's Social Security, pension if you have it. The rest of it's got to come from the portfolio, right? So in this case, I'm just going to assume they're at about 5,000 a month, and so we'll just call it 60,000 a year. Relatively normal spending at this point. Going to leave the inflation assumption there. That's more of a tax bracket and standard deduction amounts over time. So we just leave it at 2 on this side. So if we want to adjust the tax deferred accounts for that unrealized tax liability that's in there, this is where we would do that. And what number you put in there really is up to you. I tended to put whatever I knew if they had new income coming out, what was that average rate going to be? Right, for those new dollars. And so 24%, I think in this case is pretty reasonable, given I happen to know what's going to happen to these folks in the future. And I know if they start pulling out big IRA distributions, what those tax rates are going to look like. And you can toggle this on or off later, and you'll see, and I'll show you where to do that. Okay, so that's it. We've entered our data, and I was talking a lot, and so it didn't take us very long. So some things are already starting to populate here, right? We've got now our tax bracket visualizer. I haven't entered anything from a Roth projection standpoint yet, right? And I want to double check because I've got a couple of other entries we'll make here in just a moment. Yeah. So there's things like wages. So for this client, they're basically retired. So this wizard on the left-hand side will kind of guide you in terms of a workflow and just walk them through thinking about it. Are they going to have any income I need to worry about in, earned income outside of what's coming from the portfolio or Social Security? So in this case, the answer is no. So I'm not going to enter anything there. I've already entered Social Security, but it's another way to just fact check this. Yep, we're waiting until age 70. And then you can see it's got a slight cost of living adjustment over time. Makes sense. Actually, he's got a little pension. I heard Emily talk about a found pension earlier, and man, how cool would that be? Well, we know that Tony has a pension, and we know that it actually can start now. So it's 25,000, and I'm not going to give it any sort of inflation survivorship. We'll say it's 50%. It tends to default to inflation of 2 there. You can always just change it if you'd like. So in this case, I'm going to leave it at the 25,000 a year, and then you can see the impact that that's having over time. So we're just filling out income. No annuity, but if they had one or we knew they had a stream of income coming from annuities, we could enter that here. And our chart's already populating, right? We're starting to see some things here that are starting to look familiar. Hey, we've got these different tax brackets over here, and you're starting to see income populate in some of these future years, which is helpful. Now, we'll do the same for Cameron. For her, don't have any wages. She doesn't have a pension. We did confirm her Social Security, so we know what that is. Spike here when Tony passes away, her Social Security goes up. Basically, she's going to get the higher of the two at that point. And so there we are. I haven't done anything Roth conversion related yet, but we've entered a lot of data, and now we're starting to see something that's interesting and helpful. So we'll pause here for a second. Just I'll explain what's going on for those of you who maybe haven't seen this yet. So this will look familiar to you if you're used to seeing what's in some of the other financial planning softwares, that tax bracket visualizer over time, right? So this is, again, we're driving to Los Angeles and we're thinking about, okay, directionally, what might we consider? Well, we can see for this client that they've got some income coming out here in these higher brackets, right? And the different colors represent the different tax brackets based on the current law. And we know that law is currently permanent now, and so we're just assuming that that's the case going forward. But as things evolve and change there, we'll certainly evolve the tool. But let's say 37% never really comes into play, so we can hide that. Again, thinking about our client and less is more, right? So even the 35%, maybe we hide that. Okay, so now we can get a little bit more precise. And so now I'm looking here and it's saying, okay, well, we've actually got some of these years where we have no ordinary income. And we could actually generate up to about 100,000 or so before we get them into this 22% bracket, right? So that's where my mind's going is, it'd be interesting to see $100,000 Roth conversion and how that impacts them. Because we know over time, they're going to be certainly in the 24% bracket and getting closer up here, right, to that much higher bracket in 32. So this is telling me I definitely want to think about pulling some of this income, if I can, into these lower brackets, right? I mean, I could make the case to myself, even going up into the 24% bracket to try to smooth some of this out might make sense. But let's just start with one and see what the impact is. Before we bring in that Roth conversion analysis over time, because it's going to add in a new variable, you can see their base projection for total lifetime taxes is pretty significant, right, over time. And these numbers can get pretty crazy, especially if we're talking about younger clients. And one thing I did want to let you know is the ability to have a qualified charitable distribution from the Roth. Certainly you can do that now. That is coming in our tool. It's actually ready. We just haven't fully released it yet, but it's going to be coming out certainly in the next week, where we know if we start to show a client that, hey, you're going to have these massive RMD distributions, in the future, we know that from a behavioral standpoint, they're probably not going to do that. They'll start to give more money away. You'll have the ability over here really soon to just start to model some QCDs as well as part of this. So that's coming very soon. Our team's been working really hard on that. And thanks for all the user feedback. So giving you a little bit of again, painting the future picture here, thinking we want to look at say $100,000 Roth. That's only 1 year, Michael. I thought this was multi-year. It is, but I want to show first just this impact of one, and just to show you how we can kind of cook together, right? Medicare, we certainly want to fill this out because this allows me to start to make some projections around future Medicare premiums and these subsidies or the IRMA adjustments as income goes up over time. So that'd be a big Part D premium, wouldn't it? So we'll just assume they're all Medicare eligible at age 65, and we'll give them basically a $50 a month Part D premium. All right, I'm going to apply and save. You'll see a couple of other things probably pop up down here. There we go, IRMA charges, etc. All right, here we go. Let's add in a Roth conversion. I'm thinking 100,000 just to see the impact of that. And so where do we do that? Well, right here on this left-hand side. You can just now click in here. We'll start with Tony. He's a little bit older. He's the one that's got the larger IRA. So we'll go ahead and add 100, his age. We're going to do it this year. And we're going to start with 100,000. And I know that if I don't do anything else, it's just going to assume that's going to continue as long as he continues. So I want to add another year to close it out. I just want to do this for 1 year just to see the impact. So that's the way the software works. So just one little mistake we all make early on is forgetting to do that. We hit apply and save. And now let's see what the impact is. All right, so we've now got two different scenarios showing up here. We've got our base case in light blue, and we've got our Roth in darker blue. And so we can see that already we're starting to have a comparison, right? It's not a huge difference, but as we start to drill into the difference in taxes over time, this is projecting about $100,000 difference from just 1 year of $100,000 Roth conversion. If both of these clients live well into their 90s, which we know is a big if, we're projecting about $100,000 difference in the tax payments over time. And so you can kind of zoom in on each year and just see what those actual taxes are projected to be in these future years. And you can start to see kind of where that, where that break even is, or, where the Roth starts to make sense. And it's pretty early on. Um, IRMA difference, right? So we're basically saying, hey, by doing this, we're going to reduce future income enough that it's going to help you from a future IRMA surcharge. And you can see the projected difference here is 25,000. These numbers at this point don't matter as much as just the concept for us as we're talking through it. Portfolio value, which is another way of evaluating a Roth conversion, right? We really want to pay our taxes when our rates are the lowest. And it would be nice if the portfolio value went up. We want lower taxes and we want higher wealth. I mean, that's ideally what we're solving for. Or we're just trying to get assets over into Roth for our beneficiaries, so that they're not having to pay that tax over, say, a shorter period of time with the new distribution rules for inherited IRAs. So portfolio value, we do a little break even for you here. We're actually showing you that this helps pretty quick, right, for this client. So as we keep going on down here, we actually start to break down the different asset types and how they grow over time. Remember earlier where we had the ability to adjust the tax deferred assets? This is where that starts to come into play. So we can actually project the future IRA value, or, with or without this assumed unrealized tax liability that they haven't paid. So I tend to like to leave that turned on. We tend to always have to hit an apply and save anytime we make a change. So projecting out assets over time, um, assumptions down at the bottom. So that's the tool. That's how we interact with it. It's really this left-hand wizard to make adjustments, to throw in a spice or tweak the spice, right? We can taste it, we can undo it, which is a beautiful thing about the software, is we're not recommending anything yet. We're just getting ready to see the impact. I want to show you a multi-year now, because that's truly, I think, where this tool starts to add even more value. And so what we'll do is we'll go back to this Roth conversion. And now I want to make these, I'm going to make these, we'll just leave it at 100, but we'll run it out for 8 years. So at age 69, I think we'll make it 0. Okay, so we're running these out. It looks like it is adjusting it for inflation a little bit in terms of our assumptions. Yeah. User preference on that, I tended to like to not let the tool do that and just try to keep it static, because I want to be able to adjust those numbers myself. So Roth conversion of 100,000, we're really running it out, really until age 69. And let's just see what that did. Because a moment ago we were saving, maybe $100,000 in tax, and now we're saving closer to $600,000 in tax. So, and how are we looking here in terms of bringing some of these future dollars into these lower income brackets? Noisy, I got to reduce some of this, right? This is just too many lines for me. So now I bring it back to what's relevant and for this client. So you can see my blue is the base case. You can see where we ended up here. And then my darker blue is showing you here, and you can see that, maybe we went too high here. I'm not sure, but we don't have to be perfect on this, right? We just want to have a general idea. We're heading to Los Angeles. Let's get going, right? And then as we get closer, year by year, we true this up, because we know things are going to change with your client. Income's going to change. Things are going to happen. They may need to take more out of the portfolio, those kinds of things. Stuff happens. And so we really want to go back into scenario analysis and update, our baseline scenario by the end of before we really recommend something for moving to action on that or sharing it with the CPA. So that's that's how we use the tool. And that's how I would recommend you use the tool is really ability to let's look at one, let's look at multiple years. Let's now bring it back in terms of, what are we solving for? Well, we're trying to reduce taxes over time. Check, right? And I think any Roth conversion of any amount for this client is going to do that because of these larger dollars coming out in these future years, right? And what has to be true for this to actually be correct? Well, they need to live a while, right? They need to live until their mid 90s. But hey, this thing is actually working soon, right? Even if I just do it 1 year at a time, we saw the impact is very, very, very quick. And so here we are in terms of looking at projected taxes, pretty quickly. It takes us a little while before, let's say, age 69. And then when do we break even on this? Well, that's about when we get out into these look like some years I should probably continue doing some Roth conversions, right? Because we're not paying much in tax on these. So I may want to just extend these out further because I see these lines here that are just telling me, whoa, we really, maybe we don't want to go as high, in years, say 65, but let's just bring it down. Let's don't be so aggressive here, Michael. Let's bring it down a little bit. So let's back up that 100,000 and let's just make it 75. If you call what I'm trying to do there is, just really trying to not blow up these brackets, but I also saw some low years here that I really wanted to capitalize on. We really want to extend these too, I think, right? Let's extend them a few more years. Let's go to age 75, see what happens. Oh man. So, directionally, we're getting closer, right? We're kind of maxing out this 22% bracket in some of these years. We're not pushing them way up into it because there are certainly things I want to consider once I get into that 22% bracket. But, directionally, we're filling up some of these lower brackets too. So definitely have some room to get more precise with this with our other tools in terms of scenario analysis. But that's how that's how I would use the tool to help me be thinking about, all right, here's where we're headed. And then we bring it back to year planning based on actual numbers that we know are true, right? So that's, I'd say, a general guideline on how we think about Roth conversions in general. I'm going to look at the chat here just to see if there's anything I can start to help. Before I do that, we have this export function here. So we actually share the behind the scenes calculations, and it's a very readable file. I'll show you an example here for this client. And so you're seeing my kind of Mac version of this spreadsheet. But so now we've run this cash flow projection out and this tax calculation, and you can drill in here and you can actually hover over each one of these column names, and it actually explains kind of what the logic behind it here. So taxable assets are going down. This client's spending more than they're bringing in, right? And so we realize that we're going to spend from the most tax efficient place first, tracking the cost basis over time. You can see that tax deferred account continuing to grow in this scenario. And so there's potentially more room to do more Roth conversions because that pocket's still growing. You see the Roth assets growing here. And this is really our baseline assumption is what I'm looking at right now. You see that tab right there. If I jump over here, I mean, we've already got the worksheets built for you. Way to go, Andrew and team on our side to kind of walk through, hey, all right, now let's look at the Roth projection scenario. And you can start to see some of the differences here in terms of those Roth assets. Hey, we're starting to make some Roth conversions. So those dollars are going up. You can see that tax deferred client one balance is hovering about where it started. Um, so you can get in and see the portion that's investment return. Remember that 75% of the total return that I put in? Most of that's showing up as investment return versus interest. And so, it's helpful to know these things and to be aware of how the calculations are working. You're not having to do this. We're really doing it for you. So, so that's the back end spreadsheet that is already labeled and sorted in a very, very, very readable way for you to really drill in. If you have questions on any of that, you can always come to our support team. If you've got a specific case that you're looking at and things just don't line up for you, don't hesitate to reach out on those kinds of things. All right. So we have modeled. We've done a lot over the last, and I'll jump into the Q&A here in just a second. But let's just give ourselves a pat on the back here for a quick second, because we went from starting an account in Holistiplan to uploading a sample or real return, creating that household, uploading the return, looking at the tax report, right? Jumping over into scenario analysis, starting to solve for a certain amount for a 1-year Roth projection, Roth conversion for that client, that sample client. And we saw the scenario analysis, we saw the tax report. So that was great. I mean, I think that's a lot in and of itself. And then we jumped over into the Roth projection tool, and we created a standalone Roth projection scenario for our fictional clients. And we were able to kind of bake together and start to help solve for reducing taxes over time, growing wealth over time. This tool has really allowed me to do that. We've done all that, even with me being slow to share my screen sometimes, in less than an hour. And so I think you should all give yourselves a pat on the back. Hopefully you were able to come along with us and do some of this while we were going through it. But that's really the report, the tool. And so if I want to make something more visible for clients, I've got a presentation mode where they're not going to see all that stuff on the left-hand side. So now it's just a cleaner report that I can walk a client through, right? Whatever I had done on the left-hand side is now showing up. And so you can walk the client through what's going on here. I think in terms of language I would use with clients on Roth conversions, I think are one of the most complicated things that we recommend to clients. We live in this stuff all day, and I think sometimes we expect our clients to understand what we're talking about. And I would encourage you, headlines, right? Headlines and then details if they want it. So, Mr. and Ms. Client, we think a series of Roth conversions makes sense for you. What's a Roth projection, by the way, or Roth conversion? Well, it's really where you take money from your tax deferred accounts, your IRAs, etc. You've been saving all these years, and it allows you to pull that money out now and pay what we think would be lower taxes on it for you. And you can put it in another account. It can grow tax-free as long as you're alive. Your beneficiaries are not required to you're not required to take money out of it, excuse me, as long as you live. And so, we think that it makes sense for you to consider these. We've put together a scenario or two here where we're actually able, we think, approximately to help you generate, a lot of tax savings, $600,000 or $700,000 over the course of your lives. That's a big difference. And we also are going to reduce your Medicare surcharges over time by doing this. And oh, by the way, we're going to actually make the portfolio value, it's actually going to grow a little more because we're getting money and you're going to have more portfolio over time. And so we think all this makes sense for you. We will have to get more precise on the specific recommendation each year because we know things are going to change. Tax laws are going to change, but directionally, we think somewhere between $80,000 and $100,000 a year probably makes sense for you. And if that's okay, we'd like to kind of get more precise and kind of show you that recommendation in more detail. But I mean, I think most clients are going to see this number here. They're going to be like, that looks like science fiction a little bit, and they're going to see these portfolio value changes, and they're going to say, hey, that's significant. I'd like to learn more. And so I think that's how to use the tool. That's how to talk to them about it, in my mind. I'm sure many of you have better language around it. And I also like to start and review assumptions, just making sure you've got the data right. Do it with your clients, as Emily would say, because let them help you. Hey, it's a fact-finding mission too, maybe leaving assets to their kids in the form of Roth IRAs with no tax liability isn't really important to them. Maybe they want to spend it all. Hopefully you know that, but I would confirm these assumptions with them. Nothing wrong with just using this as another discovery, fact-finding mission as well with your clients. You can also print it. And so I think, I just hit print. You can save it as a PDF. You can print it out. And this is the way that looks. Hopefully you can see what I'm seeing. So it basically just prints to a PDF, or you can send it to your local printer as well. Save it for future reference. So you have the ability to print as well. So you have a presentation mode. And so with that, I'm going to kind of jump over into the Q&A, and Laura, feel free to help me there if you see any major themes of questions. And I'm going to jump here in there, and I'll start at the bottom, and we'll just kind of go backwards from here. Hello, Andy. Yeah, I'm seeing some of these are comments. Yeah, I see a question around, can this project a viable spending amount in retirement so that the client doesn't run out of money, but is spending down assets to match their anticipated spending needs? Not currently. We don't have a current ability to really solve for, a certain ending wealth value or anything like that, or making sure you don't run out of money. I think I would leverage these tools to help you solve for, the income brackets or the tax brackets that we're solving for. But that kind of will we run out of money or not question, we have a cash flow tool inside a Holistiplan. I think we're just going to have to use this as more of a tax planning tool here. Got a question about the One Big Beautiful Bill Act and all the phase out ranges for income. Yes, we do. Our tool was up to date within 24 hours. Kudos to our team on that. And so, yeah, all that's been factored into the calculations here in terms of the tax brackets over time. Where does it show the cost and taxes each year to do a conversion? So yeah, the cost of a conversion is ultimately going to show up as additional tax that you're paying. And so the best place to see that, a couple of different places. One, when we look at these projected taxes, right? So I've got my Roth case. And so my base case, I'm paying no tax. My Roth case, I'm paying 7, 8, 9, 16. What happened here? Somebody started Social Security probably, right? It's likely what happened. But so that's one way to see it. The other place to see it would be in this underlying Excel file. You can actually see the tax calculation as well. Why can't I pay the conversion tax out of the IRA until the non-qualified assets? Good question. I mean, we're really just assuming that the taxes are coming from the most tax efficient place first. And so, I think that's the underlying assumption. We don't have the ability to currently kind of change that directly here in the tool. So I think from a planning standpoint, this is going to be the most beneficial route generally, is saying, hey, you really need the ability to pay the taxes outside of the IRA. If all they have is an IRA and you don't have a taxable account, it's going to basically pull some of those dollars out, from those tax deferred assets. And then that would potentially drive up overall taxable income, and it's just going to make us pay more taxes over time. Yes, someone asked, can you toggle between nominal and real? You can. Sorry, I didn't hit that at the beginning. Right here, you can click show in today's dollars, or you can click as show in nominal. So yeah, I mean, I think that's always good. I mean, we like to show these shock and awe numbers when we're demoing things, and even for clients, I think it's helpful to, show them the future value of that. But we also understand projecting that out to age 90 can sometimes be a little bit not misleading, but not a perfect representation of what that's going to feel like. So yep, that's where you would do it, and you just toggle the today's dollars. So when I did that, it brought the projected tax difference down to about 300,000 from what it was before. And that's the same for assets as well. Roth analysis identify if and when AMT hits or proximity to Yeah, so it's not a what I would say it's not running a real let me back up on that. Let's take that one separately if because I don't want to get too far into the AMT question on that. It's a good question, anonymous attendee. That's one we can certainly talk about in a separately. Don't hesitate to reach out to our support team on that, and we can get more specific. Can you explain that taxable amount, 24% for the IRAs? Know that I fully understand that question, Kevin. Can you explain that taxable amount, 24% for the IRAs? I think I know what you're talking about. Yeah, that adjustment for the tax deferred assets believes what you're talking about, this right here. So I'm just hovering over what we've got in the app. Put a value here if you wish to show tax deferred accounts as after tax equivalents rather than as gross amounts. Some argue this adjustment makes for a more accurate depiction of the portfolio. Where you see that, it actually happens in the actual assets, kind of as we're growing them over time, and you can kind of drill into these different ones. If you look here right now at tax deferred assets, so we'll just project that out, 2.4 for client one. And then if I turn that off, I hit apply and save. We're now showing it's 3.1 is the difference there. So you see that happen kind of real time, but that's what that's for, is trying to give us a little bit more of an apples to apples comparison, because we know that tax deferred accounts there's an unrealized tax there, right? That you got to pay. Yeah, I think the best way to see that impact on IRMA is, I mean, we know that the actual IRMA premiums basically are looking back 2 years on the taxable income or the modified adjusted gross income. And so, that's the logic for this in terms of how those calculations are happening. It's going to be looking backward a couple of years on income. But, again, I think there's some logic questions there that I think are very, very, very good questions. Don't hesitate to kind of ping our support team directly on that as well. Who client, non-client, this report to, would this attract new clients with this? So, I mean, when I think about Roth projections in terms of who I would utilize this with, this was for me, it was for existing clients, right? I mean, I may not know all this information about a potential client, but if I do, and I'm doing my good prospect gathering data and they're willing to share that information, you can absolutely show this, right? You just have to get some basic inputs from them. And if they would share a tax return with you, even better, right? So yeah, you could absolutely use it with prospects because we don't need tons of data, right? We just need general data, income, expenses, broad brushes, tax deferred, taxable assets. So it's a great fact finding tool as well. Yeah, it's a great call out. So yeah, I mean, I think if you knew someone had a large IRA and these big RMDs were looming in the future, like we know that they are for most of our clients, then I would say, yeah, it's a great way to let me see, I'm not showing. Here we go. We didn't even have RMDs toggled on, Michael. Come on. Yeah, that RMD, showing the RMD over time is a big one, right? And I think that's really where we can start to create some uncertainty, maybe some doubt in our clients around what's coming. That's the big reason why all this makes sense up here, right? Is because of these bigger RMDs, but we can isolate that and make sure that toggle's turned on. Don't do like I just did. And so this RMD, we're really showing you, hey, this base case, you got these massive, and we see this in the planning software as well. But you got these massive RMDs coming in the future. Another great thing that will be coming soon, that QCD ability to show that here, will allow us to say, yeah, when you're having these big RMDs, you're going to be giving a lot of that away probably, versus taking it out and paying taxes on it. Someone asked, how do I see whether they have the premium subscription? You would actually go, and it won't look the same for me, but you're going to go into settings and you're going to go over here to subscription. And that's where it would tell you what your current subscription is. So settings, subscription. How can we find a local CFP who uses their software? I love that question, Anonymous. That is a good question. And I don't, I don't know. I think there's some great ways to find advisors out there, some great tools. I'm probably gonna gonna take a pause and not answer that one live here, but yeah, we don't currently have the ability or don't have the ability to share who's using our software locally. It's a good question though. So I think you just gotta do some digging. CFP website is a great way to find your local CFP. NAPFA, National Association of Personal Financial Advisors, is another one. NAPFA.org is a great way to find folks who are CFPs and are kind of doing fee-only planning, and our NAPFA registered advisors would show up there, and you could ask, kind of let that list guide you in terms of who's local, and then just ask the question. What should a CFP charge for Roth conversion analysis? Ah, I'm not going to touch that. I think it's um, we see lots of things out there. I think there's the one model, which is you pay us the fee and we do comprehensive planning for you. And then there's other models that are by the hour or by the project. So hard for me to really give you an intelligent answer there. Can we see the break even? How long do you have to live to get to break even? Yeah, the break even really is on the portfolio side, right? So, and as you zoom in here, you can start to see kind of pretty early on, that difference is positive, right out of the gate. Because this client had such low income, right? We were able to generate value quickly. This isn't always the case. Normally it dips down here, right? And then at some point in time, we get back into the positive territory they cross, and that would be the traditional break even if we're just looking at portfolio value over time, right? We also know that there are other factors there, right? Can make the Roth more aggressive when you invest it. We can't demonstrate that here. That should speed up that time to break even. And then really what's that tax difference? I think that's almost a bigger value sometimes, is that change in taxes over time.
All right, Michael. Super, super powerful presentation. That flew by, didn't it?
It did, yes,
Went
despite
fast.
some dead air there. So thanks for hanging in there with me, everybody.
No, that was awesome. Let's show Michael some love. He did a really, really nice job on the Roth projection Roth multi-year projection tool, which is always amazing to see the value of Roth conversions over multiple years versus just 1 year. That's really where the power comes in. So, thanks Michael for coming in and answering a lot of these very detailed questions.
My pleasure. Thank you all. Thanks for being with us and sticking with us for a big chunk of the day.
Yeah, so that was great. So we have 3 CE credit, we have 1 Roth projection bonus sesh, and that's it for today, folks. So thank you for being here. We're going to be doing one of these per month. So we're going to be doing a CE Power Hour session each month. So keep an eye out in your calendar. We'll send out the recap email that will have a recording so that if you missed anything or you skipped a session or you had to take a meeting and then come back, we'll have that all recorded for you. We'll get that posted to YouTube, and then we'll also have each of the presentations. So all of the PowerPoints with all the nitty gritty stuff on the One Big Beautiful Bill, all the estate presentations, and then Megan's insurance presentation. So keep an eye out for that, and we'll see you next time. All right. Thanks, everybody.